what I wanted to talk to you guys, just on my part that I wanted to share is kind of the state of the market. I've been to a couple classes recently where we talked, I'd been, had some presentations about like what the US is doing as far as their markets. And then I was like, gosh, how does that relate to the Ketchum market? And does it relate? And so that's what this is about. Let's see. Oh, by the way, we are all levels. Everybody's welcome. If you guys ever do have friends that you think might benefit from just networking and learning, please invite them. And this is the state. So there's 3 key indicators. Yeah, if you want to like whatever, like, oh, you can see right here. There's 3 key indicators that the federal feds look at when they're trying to figure out rates and how to deal with this. And one of the indicators is unemployment. So the federal government right now has shared that by the end of 2023, there are about 3.6 million people that are unemployed. The U.S. thinks that, or feels that, if anything is 4 million or lower, that we're a fully employed country, okay? And so what that means is if anybody wants a job, they can have a job. And the people that don't have a job don't want a job. So anyway, a lot of our markets right now, like if you're looking for work and all of that, people are taking from other companies this way, and it's not really like looking for unemployed. So this number is actually a little bit low right now. They want that to be a higher number, so closer to 7%. The second key indicator that they look at is the gross domestic product and just the difference in change. And as you can see, like in 2020, like obviously we had a pandemic, so that changed everything rapidly. In 2021, when we had just everything, we got all the incentives from the government and all that. People spent a lot of money, went up to 5.7%. Right now, by the end of the year, it's supposed to be projected at 1%. Federal government would like to see that at 2%, and so we're a little bit low than that. And the third thing that we're looking at is inflation. And this is kind of an interesting slide because they're projecting the inflation, depending on if you include energy and food or not, to be between 2.3 and 2.5%. But as of this last month, inflation is at 4.9%, and the federal government wants to see this at 2%. Like that's the comfort level of a soft landing of a good market and being healthy in the United States. And so right now it's still like people are pushing and thriving regardless of this like increase in interest rates. And the part of the reason for that is because people are getting creative, right? We're like, oh, we don't like that, so let's figure out how to talk amongst us and still make things happen. So that is, that's kind of the national level, right, of things that we talk about when we're looking at, what's working, how the market is, and that's where we're going to go next. So any questions so far? No? Okay, cool. Awesome.
So who is projecting that we didn't get into the downward curve of inflation next year into 24? That would be amazing if that happened right there, the dotted lines.
Yes.
Where are you getting that information from?
So this is from the National Association of Realtors. Okay. Mm-hmm. Yep. Yeah. So that's the reference for it. Yeah.
We're at the 6.4 and 5.7 right now.
No, we're about 4.9%. So we're kind of like right in between. Yeah, in between that 5.7 and 2.5. Mm-hmm. Yeah. Which is why it's interesting. One of the classes I recently took, I thought that the presenter made a good point. He said the federal government has very few levers to pull in order to keep this balance, right? And you guys probably could attest to that, right? And so one of the levers they can pull is like the control of the interest rates. And the analogy was that they're trying to do a soft landing to make things so that we don't just continue just to go up and down and up and down. And it's hard when you only have a couple of tools. So it's kind of trying to do a soft landing with a blunt instrument, right, is probably the way to look at it. So one of the things, and I'm sure Sarah can talk to this a little bit more, that I was hearing is that instead of maybe raising rates, they may just do higher for longer, and then later in next year have them come down. But they're coming down right now because of of reasons, which I'm sure you can talk to. So we'll get to that in a bit. That sound good? So that's my general understanding of where we are in the national market. Jumping over to local versus national. Now this is affordability. One more slide, nationally. One of the things, this is a long-term look at affordability. So it goes all the way back to how the age I was born. So if you want to figure that out, go for it. But in 1972, 22% of your income nationally went towards your principal interest payments. And then in the 80s, as you can see, that went up to about 50%. And the average over all these, 51 years is 27%. And right now, nationally, our affordability is at 29%. So it's just a couple of percentage points above the average. So even though things feel high, and I think for here it is high, but in general, getting people into the market is viable. So, questions? No? Okay. Cool. All right, so now this is more like, those are just indicators, right? So now we're gonna go into like more like what's happening nationally and in Blaine County. So on the red side, since 2021, there was 1,106 1,106 deals done, which is just over 2,200 sides, right? A buyer and a seller. And last year we went to 603. And then this year, year to date, we're at 484. So we're probably going to land by the end of the year, probably close to 500, but you can see this downward slide, right? And then nationally, our home sales have done the same thing, right? In 2021, they were just around 6 million. They went to 5 million, and they're projected, right now they're at 4.3, but by the end of the year, they're expecting about 4.1 million sales, by the end of the year. So what's happening, the actual inventory is low, and that's what's holding prices right now for things. So a lot of people are like, well, gosh, if we, bye you guys, thanks. Our parking attendants have left. So obviously supply and demand, right? So if you have low inventory, you have higher prices, and because they're kind of stuck down right now, we're having these trends going down. People are like, oh, we'll just wait for the price, for prices to go lower when the inventory goes up, and we keep thinking it is, but then it's not because of interest rates and these levers that are being pulled. So anyway, that's one barometer that we look at. In Blaine County, just going to give you guys an idea, these are rolling averages on a 12-month year. Our inventory for the last 3 years is almost identical. And this is for residential sale or just residential properties. And so it's like, yeah, if the inventory went to, 500 or more, pre-pandemic, we're about 800 or 900 homes on the market. And then during the pandemic, we went down to sub 300s. And what happened is a lot of our land got all bought up. And then all of a sudden there's not as many, there's just simply not as many properties for sale. So, hi Darcy. So anyway, that's what's kind of also holding our current market here with the values. The other two factors that are maybe values will come down or maybe they'll stabilize. We're seeing longer days on the market. And I think part of that is that people are keeping these high prices oh, let's throw it on here. Let's throw it on here. Let's throw it on here. And buyers are finally like, no, we're not doing that. And so, the sellers are starting to have to have some sort of reality check as far as what that price point is to actually get it sold. And especially because they're used to put it on the market, it's sold, put it on the market, it's sold. You can see on the right-hand side where it's month supply, our month supply has almost tripled in the last couple of years. And so it means that, and what that month supply means is if we took everything on the market, it would take us 7.5 months to sell everything that's currently on the market if nothing else came on. Does that make sense? So in 2021, things were just flying off the market. Usually you need 45 to 60 days to close a property, and 2.8 months is just about that, right? Just slightly higher than that. If a week or two of marketing, and then you've pended it and then it sells. So, so anyway, we are seeing longer days on the market. We're seeing our supply go a little bit up, which is holding prices, and they're not continuing to escalate at the level they are, but they are still maintaining at the level that they are. Does that make sense? Cool. All right. And then just for you guys to know, like, what's happening with our values, these are just the past 3 years, median and average home prices. But you can see, like, in 2021, 608,000 was the median home sales price in Blaine County, and now it's up to 882. But really, our higher end market has kind of gone berserk, for lack of a better word. Would you agree? And so anyway, we went from an average sales price of just over $1 million to 1.63 million this year. So, and we right now, I was talking to my broker, and one of my right now our market is up 15% this year. So other markets around our area are a little bit lower. Boise's down 9%. Twin Falls is down 3%. So, and a lot of that reason for us being up is because the higher end is still selling, and they're not probably as needing lending. They have disposable income. So anyway, that is my education part. You guys have any questions? Thank you.
Mm-hmm. Hey, did I hear you correctly when you said that Boise is down 9%?
Yeah.
You mean from 2022 to 2023?
So 20, like for this year, so their values are sliding. Yeah.
Year over year. Okay.
Year over year.
Like ours have increased 300,000. Theirs have decreased 9%.
Mm-hmm. Yep. I know. And it's just, and sometimes like over the years that I've been in this business, I feel like we lag behind Boise a couple of years. Mm-hmm. So it doesn't mean that in a couple of years we're not going to see a slide, but we're also like what we've gone into as far as like these numbers that crept out of COVID. You know, there's a lot of we're not turning around a whole lot. So.
What they can consider too with Boise, I mean, they just have so much more inventory.
Yeah.
You can buy the same house on one block or the other. You can't do that here. There's just
that's true.
And to be fair, a lot of the stuff that's on the market in Boise, a lot of it's in construction, which a ton of our GDP has to do with new construction. Nobody's putting up huge amounts of numbers besides Toll Brothers and, Lennar. I mean, those big communities, and they put a huge pause on things because of the supply chain. It's just a weird time.
Yeah, right.
And they can't build houses for any cheaper than what they're selling them for because of the cost to build.
Right.
Inflation as well. So
exactly.
that's why everybody in this room that hears someone say, "I'm just going to wait for the market to correct," it's like, well, when it corrects, home prices will go up because that means that rates have come down.
Right.
I think right now, and this is just from Sarah, you might back me up, Sonia, I think right now is the best time to buy a place if you can. If you can get a good deal, you can get a seller contribution to put your buy down. I know Sarah's got those buy downs. I have them, and it's like one of those things where, you know, you get the seller to contribute to that. You have a big percentage that you can get, or your realtor can negotiate it. It makes it a lot more affordable.
Yep.
People don't know to ask.
We like affordable.
Yeah.
Right.
That's why you gotta do something.
Yeah. No, thanks, Nick. I appreciate that. Awesome. Do you guys have any questions, or do you guys want to talk about anything that from what I presented so far? Oh, okay.
You did such a good job.
Seen on million and under on listings in the valley, which is, you know,
What do you mean?
Haley and Bellevue as far as listings. I know that the big listings for sales
Right.
skew those numbers quite a bit. You know, what do you see in your data on million and less, if you will? Single family.
I would say that we're still seeing increases, but probably not to the extent that like we're seeing with these numbers, right? Yeah, they're probably following more like on the median price versus the average, right? And so those sort of increases. Yeah, yeah. But we are seeing increases, and we're kind of ebbing and flowing with the inventory. It's like we'll get like a bunch of $600,000 Woodside houses, and then they'll all go away, and then we get a little, so it's kind of like little bubbles. Yeah, good question.
Are there any pockets of the market that aren't increasing right now?
Vacant land a little bit. Yeah, it's holding pretty steady. But like I think a lot of our vacant land got bought up, and now those prices are kind of here, and now it's not as demanding because the cost of building is still high.
Scares people.
Yep, exactly. What's up, Carson?
Don't we have some big subdivisions coming on that'll, hopefully, big subdivisions?
Yep.
700 lots.
Are you talking about like south of Bellevue and all that?
Yeah,
Yep.
Use the market a little bit as far as maybe, a lot more new builds.
Yeah, no, for sure. I think the biggest thing that we're looking at, Carson, is like the timing, right? So it's like they're still in the planning process. So those are maybe like 3, 4, 5 years out. And that's going to be a totally different conversation than like the here and now. And, there's factors with the current economy of like, interest rates are here, they've slid just a little bit, but what are they going to do with it? And, if they drop back down to 5.5% or 5%, like the market's going to go right back up and it could just keep going, or, like that crystal ball further out gets a little bit blurry.
Like kind of to Carson's point, they talked about it nationally a few weeks ago, but new home builds aren't going to correct our low inventory problem. They aim for around 1 million new builds a year nationally, and that's not going to touch our low inventory problem.
Right.
So that's a national thing. So
And-
we kind of are looking at that as a local Lincoln County.
In the confines of our valley, it'll help.
It will help.
Yeah. So
nationally, that's also kind of a rule of thumb.
Yeah.
So that's not
yeah.
helping us.
Do you know what the major subdivisions are?
I mean, I know like the big one down just south of Bellevue that Aaron Hill's representing, but I'm not and then there's like different phases of Sunbeam and different things like that. Do you guys have
Quigley.
Quigley? Yeah.
I have a question. I don't know the answer to this from a lending standpoint. I'm kind of embarrassed I don't. But in the state of Idaho, I think one of the main reasons for the inventory problem is because, I came from Nevada 4 years ago, and I work with a ton of community builders down there. You get in, get your name and face out there, and they start referring you to business, and that's the best thing. But the problem here that I heard is you have to buy the dirt in order to have the builder build the building. Like the builder can't sell a lot without having. Sarah, you might know better than me on this. It's a rule in Idaho that, use Sunbeam for example. Those lots all sold individually to different people. And there wasn't like a master plan. There's definitely an HOA. It has to go through the planning process of what you build. And you can't build a replica of Noah's Ark in there. But where I'm going is that, what's that?
There's design review. It has to.
Yeah, but where I'm going is it's not like a Lennar builder goes in and now they have so much money that in the state of Idaho, they can go buy all the dirt they need and they can fund it themselves, but they can't sell the property until the property is actually complete. Whereas like a builder like Sunbeam, and this is again, I'm trying to ask the question is, what are the state laws in Idaho that would, we can't go out and write a pre-approval for somebody on an empty lot because the builder can't technically sell the lot
Until they have a C of O.
at the price or whatever until they have a C of O or something like that. And it's such a hard thing for builders, just so that you guys know. It's like normally a builder will build 3 houses, use those as models, fancy them up, right? And then they'll build the community and they'll sell them kind of like in spots of 4. Like, hey, here's
Phases.
the model. I'm
Yeah,
gonna
phases.
Starting this tomorrow, and then I come in and I'm like, yep, I want that house. Build it for me. Now they've sold phase 1, and now they hit the bank to come back in and help them with phase 2, and then they just get their contractors in a row, from.
So
phase
Nick,
2,
so kind of to that, no problem. But to that point, I think it's also the confines of our area. We're in these valleys. When you're talking about a finite amount of land, the cost is higher. And so I think even though you've got builders with tons of money, it doesn't make sense to be, like, we don't have a ton of big tracts to even buy in order to do that sort of thing. So
Well, I think Sunbeam restricted. I think developer Sunbeam restricted who he's going to sell to. He didn't want developers coming in with multi-expected. He was looking for individual.
Yeah.
but and he just put his own rules down, like what he wanted, because he could, right? Yeah.
Developer.
Yeah. But I'm,
I don't know if that's
Yeah.
a law or not.
I don't know if it's a
I
law.
don't think it is, because I just helped someone do permanent financing on new construction in Twin Falls,
Sure.
and they did not own the dirt. The builder still owned it, and they bought it upon
I
completion
guess if
from
the
the builder.
builder's building it, maybe it's like you did a construction loan for the buyer. That's different than if,
No. The builder owned the dirt. The builder funded the build.
right?
The buyer, it was essentially kind of a custom. I mean, the buyer put down a deposit. You got to make the choices along the way.
Then that's,
The buyer actually was not savvy enough. They thought they owned the dirt, but when I went to convert it, they actually didn't own the dirt. They were surprised to see that they had a reservation on the dirt, but it was still in the builder's name. And they then bought it from the builder upon completion.
okay.
So I don't think it's a state thing.
There are some spec going on, not very,
Yeah, I expect,
Right.
yeah.
pretty small.
I'll find out the answer.
Yeah. Let's talk more about that in a bit.
Yeah.
Yeah. No, that sounds good. I am now going to turn
Well.
this over to Mr. Patrick Buchanan. And just so I'm just telling you what I know about real estate, and or to the best of my ability. I obviously don't know everything, but I know where to find answers. But I figured it would be nice for all of us to kind of go, hey, how's the insurance industry? How's the finance industry? How's the lending industry? How's the building industry? So if that's why I might pick on you in a minute, if you feel like it. So what do you
Thanks.
got?
Yeah. Well, you set us up for a great kind of caveat to what my industry is about. Macro, the insurance industry has gone through that same COVID pandemic swing, but we actually are lagging a little bit. So you're probably seeing this in your premiums, right? Let's just start with kind of car insurance. That's easier to discuss. Went through COVID, people stopped driving, all the insurance companies didn't know what to do, so they kind of held rates down. Insurance companies always project rates at about 1 to 2 years out. They think they can kind of project that way, so they file for rates that far out. Well, then obviously on that slide, boom, everything came back, right? Everything inflated, the cost of repair, the cost of fuel, the cost of labor, parts from China, all that stuff, and just skyrocketed. So real quick numbers. Progressive was the worst. They had an operating expense of 140%. Really, the way to think of that is for every dollar that they took in premium, they spent $1.40 in claims. So they were losing 40% off the premiums that they had anticipated with what the boomerang, the rocket ship took off with the claims experience. So insurance is kind of a lagging indicator of what the economy is feeling. So we actually did pretty well. We weathered that storm, and you can kind of feel over the last year, everybody's been, either getting rid of bad risk that they don't want, taking in less risk in the top, and then the middle of the business is feeling probably premium hikes, right? So what does that mean more specifically here? Actually, I'll stay bigger on kind of real estate. So, I don't know if anybody has experience in California, right? In real estate in California. So companies have tried in California. This is more of a state-based legislature issue, but California has put caps on the rates that they can raise, insurance rates that can raise. Well, the insurance companies had not projected that level of losses, wildfires, obviously wildfires first. And so a lot of companies cannot reclaim the rate they need. So they're just taking their ball and going home. They're just not playing. They're no longer selling cars, no longer selling homes in California because it's not, there's no return on the investment to try to insure that pool of risk. If the legislature says, no, you can only have a 6% rate, but we just spent 40% on all the losses, right? So the insurance companies basically say, well, we don't want to play there. We won't play in Florida. We won't play in California. So
it's kind of getting squeezed from all different directions, right? Yeah.
So legislation, regulatory restrictions really are state dependent, right? So that's where some states are great, some states are not so good.
How's Idaho?
Idaho is actually very good.
Awesome.
Yep, very
That's
good. Good
We live in a good
legislation,
state.
kind of work well with us. So what it means coming down to us and our community, you probably have, I imagine so many of you have had experience with some of the carriers having either withdrawn from the county, the valley. A lot of carriers, we've lost a lot of AIG, Chubbs, so all states have brought their limits down. They're not interested in taking on, as we watch the values increase on those, the insurance companies are going the opposite direction. They do not want to ride that wave of the costs that it would take to rebuild a home, right? So they just say, you know what, we can go down to Boise and we can get market down there. We can go down to Twin Falls and we can get market down there. We can spread the risk out much better across there. And so what we're feeling here is the wildfire mapping just continues to get tighter and tighter and tighter. We do pretty well. State Farm's actually been in the business, still kind of leading in the business. I can write properties all the way up 10 miles from the fire station, which is probably the most distance from the fire station that I've seen, as well as multi-million that we've been able to write. But what's happening is homes are being required to be smarter. Right? Homes are now they have to have automatic water shutoffs. Anything over 4 million has to be monitored, burglar monitored, fire monitored water, right? A lot more restrictions on roof materials, a lot more restrictions on trees, a lot more, defensible space. So what you're seeing is the insurance companies used to have a very robust insurance policy. And the ones that haven't, they can't move their policy and can't change how they've registered their policies with the state very quickly. So they just stop, and then they go back to the drawing board. They're gonna write skinnier policies. They're gonna write things with options. So wildfire might be an option as an endorsement. Like right now, earthquake is an optioned endorsement. Floods excluded. They'll go back to the drawing board. They'll come back and see what that profitability would look like and say, hey, if we don't like that wildfire risk, then let's make it, either an exclusion or an endorsement for a premium. So you'll see that's happening with like wind and hail across Oklahoma, or extremely higher deductibles, $100,000 deductibles for wind hail. So those policies are going to be a little bit more kind of a la carte, instead of having a nice, what we call homeowners, HO6, HOW policy, where it was a full replacement cost. We're going to rebuild your home like in kind, top to bottom. Now it's not going to be quite as robust of a policy. State Farm's been pretty good at that. Other companies are going to leave the market and try to come back in with
Skinnier policies.
a new presentation, a new value, but protecting their risk. State Farm actually just bought a stake in ADT. We did that for a reason. It's because we want smart homes, right? We want to know, temperature, water, all that. As we actually partnered with Ting for electric charges, spark arrest was what it was called. So that's the industry. It's going to be more like telematics, and allowing the insurance companies to have access to that data is going to give you more of a customized premium.
Cool.
Right?
Yeah.
So
Awesome.
that's pretty much the direction we're going. We've been successful in this community, but I was going to say, you need to start thinking of your home insurance as like a parachute. This is what I tell everybody. You're going to probably use it once, and you're probably not going to use it twice. Okay, so
No reserve.
no reserve. So just as advice, keep your deductibles higher, self-insure some of that lower risk, and let the insurance company take on those catastrophes, and not the things that are frustrating. So
Cool. Good advice. Thank you. Awesome. Any questions?
yeah.
What about short-term rentals and insuring?
Yeah. The market was very slow to that. They've taken it on, come into taking on short terms. I think actually the municipalities are going to slow that down because the insurance companies are slower. So there's been a lot of opportunity.
I actually caretake for a house here, and they have houses in California, and they could find one insurance carrier.
Well, California.
To insure them.
I think that's
You said California.
that's the problem state, right?
Is there anything like
Yeah.
that going on with Idaho? Are there issues with that, or
No,
changes?
no,
Okay.
no. There's still risk for that. Yeah, still appetite for that risk. Yeah.
Good question. I actually have some friends who live in California, up in kind of the forest north of Tahoe, and she called me a couple months ago and was like, what was it? I guess your just payment, right?
Premium.
For your premium
Yeah.
for your insurance. She's like, it went from like a couple $1,000s to like $18,000 in one jump, and she was just like, I'm coming to Idaho. Okay. So
USA did that
Oh,
for
wow.
the year back in August. I went from it was like a $3,000 a year policy that was at under 1,000 for the year. It tripled the rate. And it was crazy.
yeah.
Pat heard about it.
For
Yeah.
an Idaho property or a Nevada property?
Yeah.
Right.
Yeah.
Silver
And part of it is
daily.
like where you're at, right?
Like,
Yeah. Yeah. So
It's the occupant.
Anyway.
Are you seeing that? Are you seeing policies triple? Is that
No, not triple. No, I don't see them triple in Idaho. We're here. No.
okay? That's the anomaly.
yeah.
Okay.
It wasn't the house. It was the occupant.
Oh right. Yeah. Exactly. The parachute. Thank you.
Where's your office?
So yeah, I actually have an office right here on 2nd Street, but all my staff is on Main Street in Haley, right below Albertsons. Yep.
And you have an office in Twin as well?
And I have an office in Twin, and I'm opening an office in Jerome.
So, and one of the folks that came this last time, and they weren't unable to make it to this, just whatever stuff. But the Bergs that came up from the Gooding area, they're going to be a great resource potentially for us. Like if we're priced out of some potential investments up here, they might be a nice resource for us to get down there. And we've got Patrick down there as well. So yeah. So I'm going to hand it over to you of like, what are you seeing with lending and this forecast for this next year?
Okay.
There you go.
Hello. Well, you've asked me the unanswerable question, right? What are interest rates?
How's the crystal ball looking?
Yeah.
It's
Yeah, your parachute analogy. I've got a crystal ball analogy, which you already alluded to. So let's see. So with that said, let me ask, and if you were paying attention, Sonia gave away the answer in one of the previous slides. But before seeing that, I was
You're
going to
welcome.
ask, does anyone know when interest rates were the highest? Anybody have any idea?
80s.
80s. Specifically early 80s, 81. Okay, 81. It was October of 81. And at the time they were the average, right, was 16%, 16.83, I think is what I read. So it's all perspective, right? Half of that is going to be 8%, which is
right
where
now.
we were
This
a
is
month
cheap.
ago, right? So we hit the high in October of this past October was the high in interest rates flood into the 8s, right? There's been a lot of talk and a lot of speculation about when they would come down, when the economy would normalize, get back down to that 2% that everybody's aiming for. We've already seen interest rates come back down. We're now in like the high 6s, mid 6s. So that's the good news. That's the great news, you know. There was talk of, is this going to happen in 2004? Well, it's already happened now. So that makes my job a little bit easier. The Fed announcement will come out tomorrow from their December meeting, and there's no indication that rates are going to be raised, that the Fed funds rate will be raised again. It's probably going to just continue as it has for the last 2 meetings. Every indication that I've heard is that, I mean, if I personally were to tell you, right, which take it with a grain of salt, my hope and my expectation is that we'll stay in the 6s through next year. In the spring, maybe get down into the 5s again. It's not out of the question, but again, it depends on what you're reading and who you're listening to, and even within the Fed committee itself, there's different members that are saying different things. So you can spin it whatever way you want. But the good news is that you can know for sure that we're in the 6s. Does that answer any questions? Clear as mud? The other thing that I was going to say, and Nick said it perfectly, because again, that's a question that's sort of unanswerable. The good news is it's trending in the right direction. How quickly and when? But I'll dovetail on what Nick said earlier, is that the best thing that you can do, or really more important than like what are interest rates and when are they going to change, is to be creative and to work with a realtor and to work with a lender that understands temporary buy downs. Guaranteed Rate offers 5 different temporary buy downs, and what that would be is if Tara is going to buy a house, she's going to go to Sonia and say, I'd like to buy a house. And Sonia's going to say, Lenny just listed this great house for you, Sonia. Let me talk to him. He's selling it for $600,000. Okay, great. Well, interest rates are, I heard they're like 7%. I'm going to wait. And you're like, well, Sonia, who's informed,
Don't
is gonna
wait.
go,
Don't wait.
No, honey, because you're going to wait till next year and they're going to go back down to, you know, maybe a half point lower, maybe even a full point lower. But now Tora is going to want to buy the house too, and Susie. And now you're all going to be there and you're going to bid up the price of the house, and your $600,000 house is maybe now $610,000. You've paid more for it. Maybe you're saving a little bit monthly in your interest rate, but the price is appreciated if you get the house, right? Maybe someone swoops in with cash and just buys it, which we all know happens in this valley all too often. But the way a temporary buy down works is you could say, hey, Sonia, okay, I think they want $600,000. I want to offer $575. I think that's what it's worth. But I want them to kick in, and this number is variable. I'm just playing here. There's 5 different choices, and you can look at what they each cost. But let's say I want the seller to put in $15,000 towards a temporary buy down. And that's going to allow me to have my interest rate reduced 2% the first year and 3% the second year, called a 2-1 buy down. So now your 6.5% rate, you're actually paying 2% less. So now you're at 4.5% for the first year. That sounds nice. You're at 5.5% the next year, and there's every hope that then you would get in and refinance out of that before it comes back to the fully indexed rate. The most aggressive temporary buy down is a 3% reduction the first year. So again, if rates are now in the 6s, if you're savvy and negotiating correctly, the buyer can't pay for it. So you have to have the cooperation of the seller, and you have to have real estate agents that understand how to negotiate this. But if you can negotiate having the seller pay for this temporary buy down, you're buying it down 3% the first year, so now you're at 3.5%, right?
That's attractive, right?
Yeah.
Yeah.
And it's not a direct answer. You still have to qualify at the full rate. So unfortunately, it doesn't help this affordability. It does help your payment, but it doesn't help.
Debt to income's off the index rate, today's rate.
Correct. You still have to qualify off that 6.5 or whatever the full rate is, but you only have to write the check for the lesser one, right? So that's a tool that I've been trying to educate and kind of get in front of people to talk about, rather than talking about interest rates. Let's talk about what's the fix?
Yeah.
What's the workaround?
The solution, right?
Mhm.
Yeah. And that's kind of, I think that's part of the thing that we're all doing is like, you know, everybody in different industries is fine. Like, what's the problem? What's the solution, right? The saying that I've been hearing most lately is marry the house, date the rate, right? So you have this like situation where it's like, you know, in a year or so that like if it's more than 1% down, that like that's a good time to refinance. So, or I don't know if you know that, but it can, that is a good rule of thumb. So yeah, right?
Well, I'm creating business for myself. If I do my job right and help you buy the house with a temporary buy down, then you're hopefully going to come back to me when rates are lower and we refinance you, and then you've got your great.
Yep.
So to expand upon the buyer cannot buy down that, the seller has to make the concession?
Correct. So there's different buy downs and they have different restrictions. A permanent buy down, which is also referred to as discount points or points, that's been around forever, will continue to be around forever. It hasn't been talked about recently because rates were so low, so you didn't necessarily need to buy anything down. So a permanent buy down would be, Tara's buying a house, I'm offering 6.5, she really wants 6%, and I go, no problem, you can pay this mini discount, you the buyer can pay, and we'll buy down your interest rate. Okay, it's a closing cost, you pay it once at close, and you get it for the full 30 years of your loan. That's a permanent buy down. It's more expensive to get lesser of a discount. If you pay 1 point, you don't get 1% off the interest rate. It depends on the rate sheet. It's generally more like a quarter. However, the temporary buy down, you get a substantially lower rate, up to 3% lower. The seller has to pay it. The buyer, I call them the borrower, they're my borrowers, but the buyer cannot pay for it.
But you can build that into an offer, right? And say, okay, if it's 600, well, let's say you're like, I want it at 575 and it's $15,000 for this temporary buy down. You go, hey, seller, I'm going to pay 595, and then you're going to pay so it can be built in. There's solutions.
Lenny could come back and go, 575 sounds reasonable. I wanted 600, but 575 sounds reasonable, but I don't want to kick in another 15. No, I'm only going to kick in 7, and then you take it or leave it. Or they say, yeah, you know what? I'll pay the 15, but I'm not going to take it for 575. I want it for 595. It's one of the terms of the contract.
Yeah.
when someone looks at a contract and says, well, what's the purchase price? Sonia, yes, that's important, right? That's probably the biggest number in your contract, but you also want to know, is there financing or not? What's the closing date?
Yeah.
You
Lots
know,
of terms,
what's
all the
maximum
terms.
loan amount? What title company are you using? You know, is it contingent on another set? There's so many other parts to a contract that a good realtor is going to do for you and negotiate for you. A big piece being
The
financing.
machinations. Yes, exactly.
You can ask for it. It doesn't mean they have to accept it. And it doesn't mean if Lenny's like uninformed, you'd be like, well, why would I pay for the seller's buy down? And Sonia's going to say, well, do you want to sell your house? That's why you're going to pay for it. We can negotiate on a different price if you think 575 is too low, or
Yeah.
you know, it's not. They don't have to agree to it, but it gets the conversation started, and ultimately it helps the buyer, which is going to sell the house, which is going to help the seller.
Yep.
And it can also be used in the flip arrangement. If you have a listing that's sitting and not going anywhere, and you're a listing agent, maybe you want to advertise that your seller is willing to contribute X amount to a temporary buy down. And I've seen a lot of seller financing, which is a whole nother conversation, but that's being used as marketing. Buy my house, the seller will carry papers. And if the seller's got this great interest rate, and if it's assumable, which is a big if, yeah, that's a great sales tool as well.
Perfect. Thank
They
you.
can agree to the full write-down too.
Right.
Permanent write-down.
Absolutely.
We can add that in there too.
If they're going to do that, it doesn't have to be part of the contract. If it's a permanent buy down, because it doesn't have anything to do with the seller,
Right.
it's just the financing that the borrower is getting from the lender. So it doesn't need to be part of the contract. And you could do either one. You can do them together. You can do both.
But they may pay for it. If
Yeah.
they want to sell it.
They may pay for it. Yeah.
So obviously, like Sarah's got her knowledge down, right? So yes. So like all these things, it's like it's important. Like as you find investments, or as you find, like, say you want to, you know, buy a new house or sell it, like change where you are, you know, upgrading, lateral move, whatever it is, because life changes. Then there are really great professionals that, you know, are here to, you know, be able to be that access point for just having good knowledge and knowing that you're going to be well cared for. Because I've been doing it for a long time. So, Michaela, you had a question.
Oh, I was just thinking, for a secondary home, not a primary residence, you can still do 2 buy down?
You can. Good question.
That is a great question. Awesome.
Great question. And
Yeah.
there's always caveats in lending on what you can do on like a rental, but not a second home, or what you can do on conforming, but not jumbo, or what you can do on, you know, full dock, but not, you know.
Yeah.
Yeah.
Carson.
What are, what does it cost to refinance?
That's a great
Like for
question.
closing costs and stuff like that, usually, like, how do they break all that
Closing costs are going to be based on the loan amount, not necessarily the value of the house. It's going to be based on, you know, what the loan amount. The closing costs are going to be very similar to a purchase. On a purchase, the seller is paying for the owner's policy of the lender's insurance, of the title insurance, which is spending. On a refinance, you don't have, that's not split. And also the escrow closing fee, you're not splitting it with the seller. I think what you might be getting at, or maybe not, let me answer the question, elaborate a little bit, is there will be programs, and Guaranteed Rate is putting one in place right now. We're all anticipating that interest rates are going to get better, and there's going to be competition for refinances. Similar to like with insurance, I always tell people when they're shopping for insurance for a new home, like, who do you have that insures your car? Like, go to them, and they'll probably do some sort of discount for you for a, you know, multi-policy thing.
Bundle.
Bundle. I think it's similar. If I owned a house and rates went down, I'd call my current, well, they call me, because here I am. But aside from that, I call your current servicer, since they have all your information. They are going to or more than likely, most servicers are putting together programs for refinancing where they're going to be able to reduce the costs or minimize the costs because they know there's going to be competition out there. Is that,
Yeah.
it's a really general answer, but
No,
you have to pay for an appraisal, you have to pay for title insurance. It's all the general, the typical closing costs, but I do think that that's going to be changing come next year or 2025.
Cool.
Sarah, can I touch on that real quick?
Yeah, of course.
Think of it as like a percentage that if you have the equity in your home that you, let's say you bought it for $500,000 and now it's worth $650,000. Well, it really doesn't cost you anything. And as a matter of fact, you can kind of bake the cost of the loan if you do get a lower interest rate. Again, it's based on pricing, right? So pricing is whenever you go talk to a lender, you are buying whatever rate, or you're gonna get credit towards your closing costs for what a higher rate. So a higher rate, bank's gonna make more money on, right? A lower rate, well, you know, there's a buy-in, you have to buy that, but you could buy the loan, you could buy the rate down based on your equity of your home. So if you've got a house that's 70% loan to value, so what you owe versus what it's worth, you can use all of the costs in that equity to buy your rate down. And a lot of people do, because what's the gain? It's a cash flow gain. Do you really care if you got a 3.5% interest rate after you were at 6.5%? Do you care that you spend an extra $5,000 into your equity position of the house if you plan on being there for 20? No, because and so we basically, Sarah does this, I do this, you basically do a math equation. Say, hey, if you buy your rate down to 3.5%, let's use real numbers now, 5% versus 6.5%, it will take, and it saves you $250 from 6.5 to 5. It's going to take you X amount of years, because that 5% costs $5,000 more than the 6.5, or let's call it 15 grand. So you take the 15 grand, you divide it by however much money you're going to save based on the comparison of the two, and you make a decision. Am I going to be in this house, and am I good with that rate? Well, what are rates going to do? We don't know. They could bottom out again. They could go back up to 7. But if you love that payment, what does the rate matter?
Yeah, the payment's really the key to it, right? Yeah.
That's financing the closing costs.
Yeah.
Get calls from the same client often where it's like, well, I'm comparing rates to, guaranteed rate. It's like, well, no, you go off the customer service, and you go off of the fact that we're local. We have accountability to the whole community to close. Like, I had a nightmare of a situation this summer because there was no accountability on the lender, and they lied through their teeth to everyone in the transaction that blew up the deal. And people had earned thousands and thousands lost on both sides because, again, they're the cheapest rates, but they couldn't close the deal. So it comes down to a lot. I mean, you got to use somebody that you build rapport with and that you trust.
Nick, I'm gonna
I'm sorry.
keep this wrapping it. Sorry, sorry.
Get you a chair next time.
You are definitely, you're definitely on the right track. But just to kind of keep the flow good. I'm one of my things that's really important to me is to keep the time so that we're just respecting everybody's time and that we can do this. So I'm sorry, I'm gonna just cut you off for a hot second there. So
Can I say
yes,
something?
you may. Yes, but then
Nick touched on something though, on a purchase, closing costs are paid, you're coming in as the buyer, you are paying the closing costs unless you negotiate for the seller to pay them. A really important point that I think Nick is bringing up is that on a refinance, so let's say you owe $200,000 and your closing costs are $10,000. Rather than doing a new loan for just $200,000 to pay off your old loan, you can roll in the closing costs. So you get a new loan for $210,000. You don't pay any money out of pocket. Your new loan's higher, but because the interest rate is lower, your payment's lower. You're not paying any money. When a lot of the marketing, a lot of the thing, when you have no closing cost loans, that's what that is. You don't write a check. You don't see the money. In fact, you actually get to skip a payment the way it works, paying in arrears. So that's a very important differentiation, is that on a refinance, it can appear that you're not paying for it, but you're taking equity out of your house. You're increasing your loan amount to pay for it, which is super important.
Yeah, awesome. Thank you. What do you guys think? Is this good knowledge? Yes? Cool. Do you have any questions? Tor, what are you seeing in the world of building?
Building?
Yeah.
It's been pretty crazy last few years.
Do you feel like it's still going?
Yeah.
Yeah?
Busy. I mean, we're busy. We're doing good. There's options for doing other stuff. We're not slammed, but we're booked for next year. And we haven't seen a lot of people changing yet, but we sense that it's going to change a little bit. I think one of the bigger things is timing, or the timeline for construction is longer, and so projects are taking longer.
Mm-hmm. Is that because of supply?
Because of supply. So
okay.
There's not a lot of labor force. We're pretty solid with our in-house labor force, but getting subcontractors on site is really tough.
Right.
Roofers are slammed. I mean, plumbing. Every trade is behind, and they're booked. And for plumbing stuff, I just lost a job. I should be good. I'll be there next week. I haven't seen it in 2 months.
Right.
It's I mean, it's
Right, right.
So that was helpful, and we're seeing some jobs, jobs that were 14 to 18 months are now 2 years.
Okay.
The bigger projects are longer.
Yeah. Yep.
So a lot of people would be like, I really want to build and I'm not going to be in this house. I don't have an architect, I don't have a plan right now. About 3 to 4 years.
Wow.
That's a big.
That's a big chunk of time.
Big chunk of time.
Yeah.
So we're seeing a little
Right.
bit of that, and so we'll see what happens.
So then you buy this place, you live up here while you're waiting for your big
Right.
build, and then you can like.
Yeah.
Did you like that? Yeah.
Instead of a big piece of property, big house, they're scaling back, but we're still seeing some really big houses coming in the line, and I think our prices are up a lot from where we're, I think, even comfortable.
Mm.
We know that's what is actual, and that's what we're seeing, but the projects are more complicated. They're bigger and more complicated. It's stuff. We go weekly to visit our job sites. They're big.
Yeah.
And they're really complicated. They're intricate. They're more. They're more.
Insurance underwriters just can't get their head wrapped around it. $1,500 a foot
Yeah.
to start.
Or 2,000 or
They're
right?
like,
Yeah.
what are you talking about?
Yeah.
We're in the 1,000 to 2,200.
Yep.
Oh my
The
God.
houses we have that we're years into right now. We'll be finishing. Yeah, I've already been out 2 years on that job.
Wow. Yeah.
I read in the paper that there was a house that's gonna have, they said 9 pools, but it wasn't clear if they were water features or pools. Or something like that. And that the city P and Z just doesn't even, like, they've never had, and are we gonna have a maximum, square footage, perhaps, come? I mean, those are big questions and good questions, I think.
Yeah, we're seeing a house now, it's over 20,000. And like it's a change in the valley. I've heard that up today. Like this is a new valley. I mean, it's what Jackson Hole's got square foot limits, and other areas that put limits on. But they were building those big monster houses. Now we're seeing them come in. And a few years ago, it was fancier, cooler, jewel box houses, a little bit smaller square footage, but more intricate. And now they just did the same thing, but bigger square footage. So,
Yeah.
and not everybody. I mean, that's the first thing people want to build, but I'd love to build for what you want to build for. He's like, what you want to build for other folks. But it only takes a few jobs to move for.
Yeah.
Can't take everything. And where I see it's just the labor force is tight. And subcontractors, a lot of people went on their own.
Yeah, they did, right? Like everybody's diversifying right now into their own little pods, and all of a sudden you're like, I don't have my labor force anymore, right? Yeah, no, I can see that. Yeah, awesome. Any other questions? Do you guys want to network and have a glass of wine or a bottle of water, whatever you want? Your pleasure? Is that good? Awesome, you guys.
Great, thank you.
Thank you. Yeah, thanks. Yes, of course.